Hi, this is Vijay Bambwani, and today's video is about a very interesting topic as far as I'm concerned, because a lot of my viewers of these videos have asked me this question, and it frankly excites my interest as well. There are a lot of windows of opportunities opened for an average Indian investor to invest in financial markets abroad. Brokers in India are offering you the opportunity to invest in equity shares in the overseas markets. Particularly of great interest are stocks like Facebook, Apple, Amazon, Netflix, Google, etc., Microsoft, the high profile, big stakes and huge winners. So should you plunge in? How practical is it? How safe is it? What are the downsides? And what are the upsides? You see, I treat trading and investments as a business. And if you are running a business like, say, a ready-made garment shop selling these t-shirts, you would want to know the cost of this t-shirt, the kind of money that you would have to spend per sale. What is the cost of your electricity bill per month, your employee salaries and wages, your rentals of the shop, etc., etc. Everything has to be calculated down to a decimal. That's what businesses are for. So before you plunge in, it makes sense to do a SWOT analysis: strength, weaknesses, opportunities, and threats. The strength first. The biggest strength that I can think of is that you're diversifying your money abroad. You're putting it in a market which is distant from our market. It has its own unique style of functioning, and you can diversify. All well, all good. Okay, so far, so good. Weaknesses. Now, here, the problem is that you're buying stocks or maybe even commodities in distant lands where you're not going to be present and where you cannot be at a short period of time. And the knowledge that you have about that market and about that particular investment may not be complete. I completely agree with the view that risk is not doing something wrong only. Risk also includes not knowing what you are doing or not knowing enough about what you are doing. So this is one weakness. You might be investing money in a market where you know little, if anything, about, which means you're dependent on somebody else's inputs as to what you should be doing. And hey, the last time I depended entirely on somebody else's inputs, I cut a sorry picture for myself. So that is one area I'm not really very comfortable with. Opportunities, the kind of mouth-watering returns that these tech giants, which are now called FANG, Facebook, Apple, Amazon, Netflix, and Google, the kind of returns that these stocks have generated makes anybody's mouths water. It makes the kind of returns that I advocated to my subscribers in the weekly cash alert in silver and gold, it makes those returns look timid. I agree, because those stocks have actually multiplied. But then, are you too early or are you too late, or is there still money on the table for you to collect? Now this is another question altogether. Now for the threats. The 360-degree worldview system of investing and thinking of the financial markets mean that you take a well-rounded approach. You need to take care and ensure that you know everything about what is involved here. Knowledge about the stock, about the market, about the company that you're investing in, about the commodity that you are deploying money in the overseas market can be acquired. All right. But there are certain other things which cannot be circumvented or bypassed. You need to first find out how are you going to remit the money there. Is it going to happen from a local payment gateway, in which case, since you are making payments in hard currency, which means foreign exchange, there will be currency conversion charges. That's your first and immediate expense. And then On these currency conversion charges, there is GST. So that is an expense which is non-refundable. The second, when you are investing money in an overseas market, especially if you're investing money by sending money abroad, there are brokers, I completely agree with the logic that there are brokers who are telling you they can invest your money in forex markets while you're still sitting in your sofa in your house in India and not caring a damn about the world. But believe me, everything has a price, everything has a cost. So there are two threats that are primarily concerning you instead of one threat which would have concerned you if you were investing only in India. Number one, the capital erosion risk. Prices of any assets that you invest in have a right to go against you, and they do many a times after you invest your money in them. But the currency factor also hits you in these overseas markets. So what happens when you invest money in a stock at say $100 and after a year you pull money out at $120? You might think you've made 20% return, but then you will have to calculate the currency. If the currency has moved against you to the extent of 10%, you've not made 20%, you're actually getting home only 10%. That too gross. Remember, there will be remitting charges also. Even if you're operating through a broker in India, forex conversion charges and execution costs of such trades have to be, by their very nature, they have to be higher than your local transactions in the NSE, the BSE, the multi-commodity or the National Commodities and Derivatives Exchange, the NCDX. Because your broker is handling your money here in India and there is a broker there on the other end in the US or Europe or wherever, and that guy is going to charge his commission too. So your execution costs are going to be heavy. Your forex remission and conversion charges are going to be heavy. You are going to take a currency risk. You might or might not be entering an investment which could be a little late, and knowledge could be a big dampener. It could be a big dampener. So should you go ahead? My answer is not a very simple one. I know a lot of friends and a few family members who've sent their children abroad, and they regularly under the RBI's LRS or the liberalized remittance scheme keep sending money abroad to their children, and their children invest money on their parents' behalf in the local market. That is a beautiful way to go about it. You have a family member who's investing on your behalf. He's dealing directly on the US bourses without a second or a third intermediary in between, causing leakages and execution commissions and other charges, etc., etc. And more importantly, do you have what it takes by way of knowledge, by way of knowing what the cycles are? If you've recently attended my seminar on the Summit on Weekly Cash Alerts, you would have received a booklet, the Weekly Cash Blueprint. I've broken the entire 12-month year into 12 parts and said which commodity works in which month of the year, and more importantly, why. So you will have to familiarize yourself with the European market or the American market, depending on where you're investing your money, so that you have a hands-on control over your money. At my age of 54, if I have to let loose control over my money and surrender it to a game of chance, it's not something I'm open to. So only if you're comfortable, only if you're capable, only if you have complete command over your money and the odds are in your favor, by all means go ahead and invest in the overseas markets. If it is just on a whim, if it is just because everybody is doing so, if it is just because it's the fad, it's the thing to do nowadays, that's not really the right reason. Do calculate all the costs, all the benefits and the disadvantages before plunging into the overseas markets. And it would actually make sense to spend a little money and hire a local advisor, because the guy you're hiring there has boots on the ground. He's a local out there. It's like hiring a guide when you go sightseeing in another city, right? You hire a local out there because he knows the terrain best. It would actually mean saving you a lot of heartache and losses, but he'll drive up your cost. Do factor in that in your calculations. I hope I've clarified some of these issues that you had about investing in the overseas markets. Do remember that the RBI Act forbids Indians from deploying money in the overseas markets, which results in non-deliverable transactions, which means futures and options, derivatives of all types, which means you're restricted to taking delivery-based investment calls only. Maybe in demat, but it's still delivery. You cannot speculate. And foreign exchange speculation is a strict no-no. Just because you think the RBI will not know, you can get away with it. It can invite a lot of punitive measures under the Foreign Exchange Management Act. So be extremely, extremely careful. Unknowingly, you might just be breaking a law. Do consult a chartered accountant and a domain expert before you do. With this, I take leave from you in this video till I meet you again in my next. Do take very good care of yourself, your family, your friends, your investments, and your health. Have a very profitable day. Vijay Bambwani signing off for now. Thank you for watching. Also, do not forget to subscribe to my free email newsletter, Fast Profits Daily, and get my free guide, How to Trade Markets Like a Pro.